It's Friday Coffee with your mortgage man, Eric, and let's jump into it. Woo! Today, let's talk about some updates on the market. Now, it's been quite a bit of time since I've been on here, probably, a month, maybe 6 weeks. My apologies, man. Things have just been happening with the career, with the kids, traveling. Anyhow, don't want to bore you with those specifics. Let's hop into the condition of the market. Where is the market at? Man, I get asked this question all the time, and it has changed a bit. The market, as in the real estate market, what's going on? If we go back just a few months, just 2 months ago, 3 months ago, we know that the market was on steroids. Now look, it's been a seller's market for quite some time. It still is a seller's market, by the way, but what we have seen in the first half year, first 9 months of 2021 is something we'll probably never see again, and we probably shouldn't. We should probably hope that we should never see that again. The rate of appreciation that we had seen, people's homes that they bought back in January today are another $100,000 to $150,000 more in value than what they purchased it for. That type of appreciation is insane. What happened to the market during that frenzy? You couldn't buy a home. It was just extremely difficult. It didn't matter how well approved or pre-approved you were. And just to recap what you had to do to get a home back then. There was 25 offers in 25 minutes, right? That has cooled off. Thank goodness. What are we seeing now? We're seeing kind of the normal seller's market. Now, please understand, this isn't pricing going backwards. This isn't a recession. This isn't a bubble popping. This is just going back to a normal seller's market. It's not a buyer's market. It's normal seller's market. Seller lists their home. They're going to sell in 4 or 5 days, and they're going to have 3, 4, 5 offers. It's a normal seller's market. Still a seller's market. A buyer's market would be you list your home, and in 30 days it doesn't sell, and you got to drop your price, and another 30 days it doesn't sell, and you got to drop your price, and then finally you get somebody and it sells in 83 days, right? That's a buyer's market. We don't want to see that because that means your values could start to go backwards. So normal seller's market, in my opinion, is healthy. I'm seeing that's where we're going back to. Some of the purchase contracts that are landing on my desk and have landed on my desk in the last 30 days are buyers who have not had to overbid. What a concept. That's a good thing. You're bidding, asking price, or maybe even a little bit lower. Maybe a grand or two higher, but it's settled down, right? We're seeing VA offers get accepted. We're seeing contingency offers get accepted. In other words, hey, I gotta sell my home first before I buy your home. And we're starting to see those offers get accepted once again, which tells me we're headed back, we're already back into a normal seller's market. That's a good thing. Now, the thing that I think the hot topic, right? And unfortunately, it's always your neighbors or your parents or somebody that believes that they know so much about the mortgage industry or the real estate industry. They're the ones that are probably fanning the flames of it's gonna pop. It's gonna be another housing recession. It's just they can't go up that high and not come down. And look, here's the reality of it. There's no indication. There's no indication of a housing bursting bubble, a recession, property values plummeting. There's no indication of that. Why? Here is why. It's numbers. It's just straight up numbers. Go back. Let's look at what created the last housing recession, the implosion. There were 2 things that created it. One was you fogged the mirror, you got a home loan. I mean, the stated income programs, exotic loan programs, whatever you want to call them, that was problematic. People were buying 4 and 5 homes, and they were investors who didn't have a clue about, owning rental properties. And you had this problem of inventory, okay? You had 6 to 9 months of inventory, which is a decent amount of inventory. It's kind of a healthier market, right? But we don't have that inventory right now. We haven't had that kind of inventory since the recession. Why? Is because builders have not been building. Builders should have been building at a pace of 2 million homes a year, nationally speaking, and they were only building at a pace of about 500,000 to 600,000 homes per year. Do the math. That's why we have a housing crisis, right? We don't have the inventory. If you had the inventory, if you had a surplus of the product, that could potentially drive the cost down. But we don't. We don't. More and more people are coming here. More and more people are being born. More and more people are becoming homeowners. Just is the natural evolution of things. And we have less and less homes. Is what it is. I mean, that is simple economics. There's a high demand and a low surplus. And there's nothing there to mitigate the problem. Builders can't build enough homes to turn that around. Why? A number of reasons, right? I mean, there's no land, environmental issues, and can't build in this preserve, and can't build, right? I mean, where else are we going to build? We're going to build out in the middle of nowhere. Well, who wants to live out in the middle of nowhere? Most people want to flock into the city. Why? Because there's opportunities there for jobs and economic growth, right? I mean, it's all mathematics, simple mathematics. So there's nothing anywhere that says the housing bubble is or we're in a bubble. There's nothing anywhere that says that. There's only, actually in here in Arizona, it's only looks like it could potentially get worse because of the migration of people from California. For a plethora of reasons, people are still leaving California and coming here. We're going to continue to see that migration probably for as long as we're on the planet. That a number of reasons people are going to be leaving California to come to Arizona. So that just adds to the issue that we have here. The high cost of living. We're in an inflationary status across the nation right now due to a number of things that I could talk about for the next 2 hours. But we have serious inflation issues, which creates the cost of goods to build homes, to renovate homes, to build extensions and add-ons. It creates them to go up. The cost to continue to go up. So when somebody tells you, well, we're going to wait because I know it's going to pop. I know those homes are going to go backwards. I just know it. Well, man, I hope you're going to wait for the next 20, 30 years. That might be what it takes. I mean, simple mathematics. Look, if we were sitting here with 6 months of inventory, I'd be like, dude, you might be right. But we're not. We had 2, 3 weeks of inventory. Not even a month. That's insanity. We don't have the inventory for a bubble, or a bubble to burst, or the housing recession, or property values to go backwards. We just don't. It is what it is. Anyhow, moving on. Next topic, last topic. Let's talk about rates, shopping for rates. And I think I've probably brought this up 1 or 2 times before in the history of doing these videos. And here's the thing. Have you ever heard of front-end loaded interest? You probably may have heard the term somewhere along the lines. So if you get a 30-year fixed mortgage and you look at your mortgage statement. Now look, if you've never owned the home, you've never had a mortgage statement, I'm sure you know somebody that does. They'd probably be happy to share with you their mortgage statement, I would assume. Look at that mortgage statement. And if you have a $1,000 a month payment, well, you're blessed if you do, if that's all it is. But let's just take $1,000 for example. And if you look at that payment, how much of that $1,000 is going towards the principal? How much is going towards the interest? And the first thing you got to understand is the difference between principal and interest. If you ever never owned the home, you may not understand that. Interest is really just money thrown out the window. I mean, it means nothing. It's going towards nothing. It's just interest. So, follow me here. If you get a 3% mortgage or 2.75% mortgage or 2.5% mortgage, it means nothing. It means very little. Why do you say that? The difference between 0.25% and on an interest rate is all but meaningless. Here's why I say that. Because in order for you to actually get the true interest rate that you shopped around for and got 4 quotes and stayed up late at night and did mathematics and you're going to save $13.18 a month for, you've got to keep that mortgage for 360 months. You've got to make 360 payments. Why do I say that? Because it's all front-end loaded on interest. So example, if you took your mortgage that you spent all that time shopping on and went with some internet lender because they got you an 1/8 or 1/4% lower, look at the interest, okay? How much of that payment is going to interest? So for example, take a $250,000 loan, $250,000. And let's say you're at a rate of 3%. And all of a sudden, a year later, you're refinancing because rates dropped, values went up, you're removing the mortgage insurance, you want to tap in and get some equity and do some remodel, you want to pay off some credit card, whatever the reason is. You got divorced, somebody's got to come off the mortgage, you're getting married, you're going to put somebody on the whatever the reason is that you're refinancing, and a year later, do you realize that the true interest you just spent on those monies that you borrowed is about 480%? What? Yes, nearly 500% interest on the monies that you borrowed. That's ridiculous. How do you come up with that? Again, the interest that you paid, it's front-end loaded. That means it's so lopsided. In a $1,000 payment, you might be paying $850 in interest and $150 to principal at the beginning of that 30-year fixed mortgage. You get it now? $850 a month in interest. Okay? That's not 3%. Follow me? You're not paying 3%. That's not 3%. That's close to 500% interest on the monies that you borrowed if you refinance in a year. Now, if you're like a normal statistical consumer and you're refinancing in 6 to 7 years, good news, you're only paying about 94% interest. What? Exactly. 5, 6 years, 7 years into it, you're still so high on the true interest that you borrowed those monies for. So if I said to you, hey, I'll loan you $250,000 and the interest rate is 87.5% on the interest rate, you would think I'm out of my mind, right? And rightfully so, but that's what you just spent. You just refinanced, 6.5 years into your mortgage, and we're going to do another 30-year fixed mortgage, and it's not uncommon. So many consumers do it, There's other alternatives you could be doing, going into a 20 and into a 15. Nonetheless, the monies that you borrowed for those 6 years, what the true interest that you paid on them, because all that money went into the interest and not the principal, was nearly 100% on the interest. So, you see where I'm going with that? When you spent all that time trying to save yourself 1/4% or 1/8%, so maybe you could brag to your coworkers or your family around the dinner table or the Thanksgiving table. I don't know what it is about that. I got 2.5% rate. I don't understand that. The 30-year fixed is called the banking industry's biggest secret for a reason. They want you to take a 30-year fixed because they know statistically the odds of you making 360 payments is slim to none. You might run across one person in their entire life that actually kept a 30-year fixed mortgage and made 360 payments. Didn't accelerate. They may have paid. Actually made 360 payments. That's 30 years, by the way. So nobody does that. It's the banking industry's biggest secret. Take the 30-year fixed. Absolutely. They're going to make tons of interest on you. So you see what I'm saying? You shop until you're dropping. There isn't much sense in that. And here's another reason why. When you're looking for your real estate agent or your mortgage professional or your financial advisor or your plumber or your electrician or whomever, your landscaper, right? When you become a homeowner, you need these people in your life. When you start navigating life and you're having kids and you grow a family and now you're starting to look for retirement, you're not always going to be 25 years of age. You're going to be 45, right? You're going to be 50. Hopefully, if you live long enough, you'll be having a family of your own. You're going to just consist of you, and you're going to navigate and work towards retirement, right? These are the things that you want in your life. You'd want to have a plumber that in your sphere of influence that you can call up and say, hey, I got a leak under the kitchen sink. Here's the garage code. Help yourself, let yourself in when I'm at work, rather than shopping at night for 2 hours to find a plumber that is $28 cheaper for the trip charge, and you don't know them, you don't trust them. They might do, shoddy work, and you certainly, now you got to take off work to be there with them to let them in because you don't, right? You want to be able to trust these people in your sphere of influence. So it's not always about the lowest bidder. It just isn't. And sometimes it takes us as a consumer some time to figure that out. It's not always about who's the cheapest, who's the lowest bid. It's about who we trust, who saves us time in life. Because at the end of this, time is the most valuable thing, not money. You'll learn that the older you get. I know I did. 25 years ago, money was probably the most important thing, my early 20s, right? And before I had kids, and you started understanding the other values of life are much more important than chasing the dollar. Just is. So, a little food for thought. Look at your real estate agent and don't look for the cheapest. Like if you're listing your home, I want to find somebody who's going to list my home for 1%, or $3,500 flat fee. Dude, that's not, you're missing the boat. You want your real estate agent that you know, that you trust, that becomes part of the family, that you send Christmas cards to, that they send Christmas cards to you, right? They send you gifts. You'd invite them to the cookout. You'd invite them to dinner. They're going to invite you to the cookout. This is how you want to treat the people in your sphere of influence, because they're there not just for the transaction. You want them to be there when you have questions, when you've got kids, when they're looking to buy their first home, and how do we do it, and how do we start, and asking your real estate agent about questions about certain neighborhoods or upgrading or downgrading. They're phone calls, professional advice phone calls that take place. That's well beyond the scope of just the transaction. So keep that in mind. Little tips, little advice. With that said, it's Friday Call to your mortgage man, Eric. 602-757-2171. We'll see you.